Building wealth requires smarter financial planning to achieve financial well-being. This is why only 1% of the population are fortunate to reach this level. By understanding how the UK tax system impacts your progress is crucial, so you can make informed financial decisions to maximize your financial growth potential. Hi, if you are new here, I'm Amelia, a financial risk consultant with 15 years of expertise working for some of the top financial organisations. The UK operates a progressive tax system where tax rates increase according to the growth in your income. I like to think of it as a staircase, and with each step up, you pay a slightly higher percentage on the additional income you earn. Therefore, it's important to understand the tax brackets and how they work. In this video, we'll cover how the UK tax system actually works, how the UK tax system prevents you from growing wealth, and the two most effective ways you can significantly reduce your tax. Income tax is a percentage deducted from the money you earn, which is paid to the government in line with the tax year from the 6th of April to the 5th of April. Everyone in the UK is allowed to earn up to their personal allowance before income tax is deducted. So in this tax year of 2024 to 2025, the personal allowance is £12,570, which you pay 0% tax. I'd like to add that in the current year, a blind person can earn an additional £3,070 for their personal allowance. In the UK, there are 4 different tax tiers compared to the US, which has 7, where the percentage of the tax becomes higher according to the rise in your income, which exceeds your personal allowance. So we know that you pay 0 tax on the income up to £12,570. The second is the basic rate at 20% tax of your earnings that fall between £12,571 and £50,270. The third is a higher rate tax at 40%. This is on earnings between £50,271 and £125,140. Lastly, we have the additional rate, which you are taxed at 45% over £125,140. Now, compare this to the US tax system, which is referred to as the IRS, who also have a progressive tax system which ranges from 10% to 37% and has a higher income threshold for the highest tax bracket than the UK. In the US, the maximum 37% tax tier is effective at around $609,000 plus, which is an estimated £487,000. So you can see that this is substantially lower than the tax in the UK. Also, once you earn over £100,000 in the UK, the government will deduct £1 from your personal allowance for every £2 you earn, which is 50% of your income. That means you no longer have the right to earn any tax-free income. This can discourage high earners from pursuing significantly higher salaries, as a large proportion goes towards paying tax. You might also pay national insurance contributions, which is a social security deduction from your salary. These contributions help fund healthcare and other benefits. By contributing more into your pension and donating to charities, this can help reduce your tax. So you'll find that people who are on low incomes pay either no or low taxes and can claim different benefits such as universal credit or job seekers allowance to increase their income. This can cause this group of people to be pushed up into a middle bracket, whilst those who earn over the £100,000 are pushed downwards and end up in the same bracket because of the highest tax tier. Although these groups of people are very different, this is a good example of how taxes and benefits are set up to ensure that most people end up in the same bracket, which means that you can never become wealthy through this tax system. When tax is calculated, it's not calculated on the full sum of your income at the highest tax tier, as most people may think. So here's an example. Let's say you earn £100,000 a year. You'll pay 0% tax on your personal allowance of £12,570. Then the next £37,700 of your income is taxed at the basic rate of 20%. So you'll pay £7,540. Then on the remaining income of £49,730, you'll pay 40% tax, which will be £19,892. There are effective ways you can pay less tax. Some of these are through capital gains, dividends, and ISAs. In simple terms, capital gains is a profit made on an asset when that asset is sold. So for example, you buy a property for £300,000 and sell it for £450,000. Your capital gains is £150,000. A capital gain is normally a type of gain on properties, bonds and stocks, but for basic rate taxpayers, it can also be on the sale of business assets. The capital gains tax rate is 10% or 20% depending on the type of underlying asset being sold. Higher and additional rates taxpayers are 20% and 28%, which are significantly less than the income tax rates explained at the beginning of the video. So of course, due to lower rates with the ability to defer tax, which allows the wealthy to control when they pay their capital gains, as this is not due until the asset is sold, combined with the wealth accumulation where returns on capital like stocks or property often grow faster than income from labour, means that those who have substantial wealth and investments can accumulate more wealth quicker. While capital gains offers some tax advantages, planning is essential. It's important to have a solid investment plan in order to be able to benefit from lower capital gain rates. This might involve gradually transferring some of your income or savings into stocks or property. And secondly, as much as capital gains taxes can be valuable for growing your wealth, building wealth takes time, as replacing your entire salary with investment income can be challenging. It's typically required a significant amount of capital already invested to generate that level of income. Now, for limited companies, the tax system is different and allows you to pay less tax on your profits. You can pay less tax by becoming a director of a limited company. You can use this corporate structure for income that you earn from self-employment. So let's say you earn £60,000 under your limited company in a 12-month rolling period, and you need to write off any business expenses against your earnings in that same year. So let's say you take a client to dinner and that costs £4,600. Your travel expenses are £4,800 and work equipment at £2,400, and let's include some hotel stays at £2,700. So your total expenses would be £14,500, which means your taxable income would only be on the amount of £32,930. As a company owner and also as a shareholder, you will pay yourself dividends from that income, which acts as your salary. The first £500 of those dividends, you won't pay any tax. The tax you pay on these dividends as your only source of income for the tax year 2024 to 2025 will fall into the basic rate of 8.75%, which is much lower than the income tax rates that are associated as an employee. Dividends in the UK have 3 tiers. These are 8.75%, 33.75%, and 39.35%, and the US still remain at the 7 tiers with a maximum threshold of 37% tax, as mentioned earlier in the video, which you can see is much lower than the UK. So we have individual options like ISAs, which are tax-free. There are 4 different types of ISAs, which are cash, stocks and shares, innovative, finance and lifetime ISAs. However, you do have a contribution limit, which currently stands at £20,000 in this tax year of 2024 to 2025. Now, you can split your ISA allowance of that £20,000 between each of these ISAs. Now, while ISAs offer a tax-free growth, the limit restricts the amount of interest you can earn each year. This is not the only barrier, as the interest rates on cash ISAs and general savings accounts are typically lower than the rates of inflation. And despite the drastic increase in interest rates, especially in 2023, along with the current rising cost of living, savings have not stayed aligned to the interest rate increase. This means your money technically grows, but your buying power essentially shrinks over time. So despite paying no tax using an ISA option, it will not enable you to become wealthy. So let me just give you an example. Let's say from the age of 25, each tax year you invest your full ISA allowance of £20,000 into a cash ISA with an interest rate of 5%, and the interest compounds over a 20-year period. Then you could see a possible return of around £623,000 at the age of 45. Although this sounds like a huge sum of money, we have to remember the cost of living is continuously rising, whilst salary increases are normally below the rate of inflation. Also, investments can go down as well as up. If you would like to know more about ISAs, then please let me know and I'll make another video covering this. If you found this content beneficial, then please share, subscribe and like this channel, as it would enable our community to grow and provide you with more useful content to inspire you. Thank you for watching, and I'll see you in the next video.